This is the video demonstration for credit card sales and bad debts. And in this video, I'm going to work the solution to example number 7. Now this involves the golf company. And the information here says that the golf company allows select customers to charge. All other customers must use the Access credit card. The Access company charges a 2% fee and remits payment to the company once per month. The golf company also will directly write off any debt that is determined to be uncollectible, and we also use the allowance method to estimate bad debts. And it says they had the following transactions related to credit card sales and various other sales and bad debts in the month of December. So we have a whole series of different transactions that occurred all throughout the month, and under the requirements, the only requirement is simply that we are to do the necessary journal entries for all these transactions. So to do this, I have my traditional journal entry page set up in Excel. Of course, like I say, you could do this on paper either way, but I'm going to do one journal entry for every transaction. In fact, there will be a couple transactions where I might have to do a couple of entries if it's a sale. So what's the first transaction? First transaction is on December 1st. They sold merchandise to a customer using the Access credit card. The merchandise was sold for $500 and it had cost $430. So this is occurring on the first day of the month. Now, the Access card remits payment once a month. So that means they're going to owe me the money. So that's a receivable. So I'm going to debit accounts receivable, Access. Eventually the credit card company once a month is going to send me that money. Now they're also going to charge me a fee. So when I do this journal entry, I actually want to skip a space before I credit sales. Now the amount of the sale retail price was $500, but it's not going to match up because remember the credit card company charges me a fee. And it said at the beginning of the problem, this particular company charges a 2% fee. So I'm not going to get the entire $500. I'm actually only going to get 98% of that. And the decimal equivalent of 98% is 0.98. So when they eventually pay me for this, what will I actually receive? Only $490. So now you see why I left a space there, because this is not going to match up. I need another debit, a debit for $10 to make it work. What's that $10? That is simply a credit card expense. Now it also told me in that same transaction, since that was a sale, it said that the merchandise had cost $430. So remember, whenever there's a sale, you actually have to do two journal entries, one for the retail price and one for the cost. We know exactly what to do because we actually did that in a previous video with sales. For the cost, we debit cost of goods sold and credit merchandise inventory. So that takes care of the December 1st transaction. Next transaction is on the 3rd. This time they sold merchandise again on credit, but this time it says to a frequent customer, and it had cost $1,000 and was sold for $1,750. Remember, it said some customers use the credit card, but it also said that we had certain select customers that we allowed to charge. So evidently this frequent customer is one of those. So this is actually going to be a little bit more straightforward. This is going to be more like a traditional credit sale. So in that case, we will debit accounts receivable and credit sales for the retail price, which is $1,750, and then we will debit the cost of goods sold, and we'll also credit merchandise inventory, and that'll remove it from the inventory, and that will be at the cost, which they said was $1,000. So that's more or less like a traditional credit sale that we've done in the past. Next transaction is on the 10th. Now this transaction says we have an account receivable from S. Smith, $500, and it is uncollectible. Why are they saying that? Well, look at the next sentence. It says this receivable has been on the books for over a year. Well, if it's been on the books for over a year, chances are this person is never going to pay. So they did say at the beginning of the problem, any debt that we know is uncollectible, we would go ahead and do a direct write-off of that. So on the 10th, I'm going to directly write off that $500 receivable. When I do that, that costs me money. That is going to be bad debts expense. And I'm going to remove accounts receivable for S. Smith. So that'll show the expense, and it will also show that we are removing the receivable. It's uncollectible. Then on the 15th, another transaction. This is another sale. This time the customer is using the Access credit card. It was sold for $700. It had cost $450. So this is going to be pretty much exactly the same as that entry that I did up here on the first. Really, it's going to be the same titles. So this is on the 15th. It's going to be accounts receivable, Access. We're going to have a certain amount of credit card expense. So both of those need to be debited. We need to credit sales. We need to debit the cost of goods sold. And we also need to credit merchandise inventory. Now the amount of the sale this time was $700. Again, we're not going to get all that. We're going to get 98% of it because of that 2% fee. So really only going to get $686, and there's a difference there of $14. That's the credit card expense, $14. And what was the cost of that merchandise? $450. So that completes that transaction. The next transaction is on the 17th. This time it's another sale. This time it's to another one of these frequent customers that we allow to charge on us. It had cost $1,950. It had been sold for $3,000. So this is going to be like a pretty typical credit sale once again. So we will debit accounts receivable and credit sales. And then we'll debit the cost of goods sold and credit merchandise inventory. It says that it was sold for $3,000 and the cost was $1,950. So that takes care of that transaction on the 17th. Next transaction is on the 21st. It says collected the balance due from the December 3rd sale. So whenever we collect money like that, we're going to have a receipt of cash. So this is on the 21st. We're going to receive the cash. We're collecting it from the account receivable. And it says this was from the sale on the 3rd. So I want to go back to the 3rd. That was the sale on the receivable for $1,750. So if I'm receiving that money, that's going to be $1,750. So that takes care of that transaction. Next transaction is on the 25th. We're going to collect the balance due from Access. So this is on the 25th. We're going to collect the cash. We're going to credit accounts receivable, Access. The only question here is how much. Well, we actually had a couple of instances where they owed us money. So if we go back and look at it, way up here on the 1st, they owed us $490 from that sale. And then down here on the 15th, they owe us $686 from that sale. So it's going to be $490 and $686. So $490, $686. It's going to be $1,176. That's how much we will collect from that credit card company. And then the final transaction is on the 31st. says recorded for allowance, the allowance for debts for the month, and based on previous experience, the bad debts are estimated to be 1% of all outstanding receivables. So this is going to be on the 31st. Now, as far as the titles, we talked about this in our video lecture on accounts receivable. Whenever I do the allowance method, the titles that I use, I debit bad debts expense, and then I credit the allowance for doubtful accounts. Now, every company has their own way of estimating that. What was their way? 1% of all outstanding receivables. Well, I want to go back and see at this point, do I have any outstanding receivables? Well, I had a sale there to Access, but remember, Access paid me the money. I had a sale here to a customer for $17.50. I collected that $17.50. I had another receivable here from Access. I collected that as part of the credit card collection. But down here on the 17th, that was another one of those credit sales for $3,000. I still haven't collected that. So as of the end of December, out of all the things that went on in that month, that's still the one thing that's left there is outstanding. So that's $3,000. So what I want is 1% of $3,000, which is $30. So I'll go ahead and record an allowance for doubtful accounts of $30 in order to account for the fact that I do have that one outstanding receivable.